Hey, happy Wednesday, everybody. It is time for managing an options portfolio. My name is Brent Moores, and we do that each week at this time where we're going to talk about managing option trades, possibly adding in new trades into our options portfolio, and hopefully just educate you in the world of options. I'm glad to be here. I'm glad you're here, whether you're watching live or on a recording. That's great. I'm joined by Mr. James Boyd, who's helping me out in the chat. Appreciate James. So as you have questions, feel free to type in those questions in the chat box if you're watching live. And between James and myself, we'll do our best to get those questions answered for you. You can follow us on X as well, at Brent Moore CS, at James Boyd CS, for additional content throughout the week. Now, we are going to be dealing with options today. Let me go through the disclosures, then I'll tell you just a little bit more about what we're going to be going through. Options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only. It's not a recommendation of any security strategy or chart pattern. Schwab does not recommend the use of technical analysis as the sole means of investment research. And the paper money application, which we'll be using, is for educational purposes only. All investing involves risk, including risk of loss. You can lose the principal on the trades. Let's see, past performance of any security or strategy does not guarantee future results or success. And the paper money application will not assign a short option position early, which is different from a real trading account. So today what I want to do is I want to talk to you about a strategy that may be relevant in today's market. And so, you're going to have to decide how you approach the market. We're going to look at that in just a sec. But the strategy I'm going to do, it's kind of a little bit of a less common strategy. It can be easily confused because very often we talk about iron condors. But what I'm going to talk about today is not an iron condor. I'm going to talk about a plain old vanilla condor trade, a call condor or a put condor. Those are not iron condors. They are more of a neutral-ish strategy, ones that tend to benefit from a drop in implied volatilities and benefit from time decay. So that's kind of the starting point on this. But before we get too far into this, let's just kind of mention some things in terms of, just in terms of technical analysis here. We've had a downward trend. We had highs and we've had lower highs, right? We had lows and we had lower lows, but more recently we had a higher low and now a higher high on that. Okay, so a little bit of a mixed picture in that regard. On the S&P 500, we had what was a kind of a resistance level kind of in this area there. Okay, and so and we had a low way down here. So we're well off of our lows. We came up to this resistance level almost to the 50-day moving average, but it looks like we've bounced down a little bit. Now, we're actually down. We've recovered a little bit. We're down about 1% today. So the market's kind of hesitating. We had 6 closes higher in a row. A little bit of a hesitation day. So is this a resistance that's breaking? I don't know. Potential support in this area. And, you can also think about this from a more of a macro standpoint in terms of for the market to go back up to these highs, what do you envision economically on that? We had a GDP report that was, we'll say, poor today. The market has kind of largely shrugged this off at this point, to be honest. We're down a little bit, and maybe it was kind of due for a pullback anyway. So it's, and if you look at this candle, that's actually kind of like a hammer candle there almost. So we're really not down that much at this point. So the market's mixed, I guess, would be one approach to this market. Now, the strategy I'm going to talk to you about today is a strategy that is not one where if you think this market is going to scream back up here, that you would do. Okay. It's also not one that if you think this was just a kind of a brief reprieve and we're going to go way down here, it's not a strategy you would do. So it's something where we're looking for, maybe it goes up and down a little bit, but we're going to stay largely in this range here. That's what the strategy is that we're going to be looking at. Okay, that's where a condor strategy is going to come in play. Now, what's a condor? Well, let me start off with telling you what it's not. It's not an iron condor. Very often we talk about iron condors, and an iron condor is simply a short call vertical and a short put vertical. You put them on, and if they're both on at the same time, that's your iron condor. That's not what we're talking about, but this is a bearish trade, a short call vertical. That's a bearish trade, and a short put vertical is a bullish trade, and we want the stock to stay kind of in between those. But what I'm going to talk about is a condor where you can either do with calls or puts. In the case of a call, we're going to do a short call vertical. That's similar, right? That's similar to that iron condor. But we're going to keep it all calls, not calls and puts. We're going to keep it all calls, and we're going to do a long call vertical. In that case, a long call vertical is a bullish trade. A short call vertical is a bearish trade. And so we want the stock to go down from there. We want the stock to go up from there. And so basically we want the stock kind of to stay between our trades. And so that's how that works. A short call vertical, by the way, is going to be a long call and a short call. And a long call vertical is going to be a short call and a long call. And if the stock stays between those, the stock is going to be closer to our short calls on both sides. And those are generally going to mean it's going to be a positive theta trade. Time decay helps us out in that case. Well, positive theta is great. Okay, that's what we want. We want positive theta. There's pros and cons, but we like positive theta. But another thing is it's a negative vega trade. And so if we look at implied volatilities on the market, they had spiked up pretty significantly. They've kind of eased their way down. And if implied volatilities continue to drop down, where are we at right now? We're about 25 right now. You can see earlier today it spiked up a little bit, but earlier today we were down more. But if implied volatilities kind of creep down a little bit, then that would tend to benefit this trade as well. So let's look at an example here of this. So for our purposes, well, I'm gonna find a stock, and you can sort through your stocks. Whatever stock you're doing, what we want is, I don't care what type of option trade you're doing, we care about liquidity. So you want a stock that is going to be a more liquid stock. JP Morgan is typically a more liquid stock with more liquid options here. But I want something that's not super directional. And I think what I can say is, from this technical standpoint, we kind of have had this thing going, okay? And more lately, we've kind of had this thing going. Potential resistance here, potential support kind of here. I'm under no illusions that this stock is going to go just flatline here at this point. Maybe it bounces up and down, but very often when it bounces up, it kind of comes back down. Or when it goes down, it kind of comes back up. That's what we're banking on here on this. That's what we're planning on. So in this case, what we would be looking for is we'd be looking to do a bear call spread. Bear call spread. Now, that's a different term than I used before. Before I used the term short call vertical. They're the same thing. Those are synonymous terms up there. And I'm going to do a long call vertical down here. We could also call that a bull call spread. Again, long call vertical and bull call spread are synonymous. And we want the stock to kind of stay between those. So how far out should we make these? Well, there's different ways to do it. One is you can do what we often do, and that is we could say, look, I've got some resistance, potentially resistance up here. So I want it kind of up in that range. I've got some potential support down here. I'm not going to go all the way to the lows, maybe. Potential support down here. So support, resistance, and I'd want my contracts to be for my short call vertical at or above resistance, for my short call vertical, my long call vertical at or below support. That's one way to do it. Another way we do it is we can look at like delta from a probability standpoint. You know, when you're trading, there's a lot of different approaches to trading. For example, you can take more of a fundamental approach. James sometimes hits on that more in his trading growth and value stocks class. That occurs later today, 4 o'clock Eastern time, trading growth and value stocks. He hits up more fundamentals in that class. That's certainly an approach you can do in the markets. Okay? You can do a technical analysis approach with trend and support and resistance, which is kind of what I've just been talking about. But there's another approach you can do in the market that we often do when we're talking about portfolio management, and that's called a probability approach. Probability approach. And for probability approaches, we'll use measures, statistical measures in the market. Measures like probability in the money or probability out of the money or probabilities of touching. Sometimes what we'll use is a measure we call delta. Okay? Delta is an option Greek that tells you how much an option price is going to move, expected move, in relationship to a $1 move in the underlying stock. Okay? But it can also double as a probability measure as well. And for a probability measure, it can also tell you the chances, the probabilities, and there's certainly an inexact science of an option being in the money. So if I'm looking at JP Morgan and I'm looking at this, what I'm going to do here is I'm going to go out, we'll go out a little ways. I'm going to go out to May 23rd. We're past March at this point. May 23rd, and I'm going to look at this delta column, and I'm going to stick with calls here for now. Just realize we can do puts too. And it's essentially going to be a very, very similar trade if we do it with puts. In the case of calls, we're doing a long call vertical and a short call vertical. Okay. In the case of puts, we're going to do a long put vertical and a short put vertical. And we want the stock to stay between those. Now, I'm not going to focus on puts right now. I'm going to focus on calls. But just realize you can do it with puts as well. All right. So let's do this. Let's look at what strikes would we do? What strikes do we think it's unlikely that the stock, which is now around $242, to go above? Well, I'm going to use that delta, that measure that we can use for probability, and I'm going to look for a delta somewhere in the range of 20%. 20 delta. Here, we don't have anything exactly 20, so I'm going to go to 22. And this is going to be my short call vertical. I'm going to sell. I'm going to click on the bid price, and I'm going to sell that. I'm going to hold down my control key. I'm going to go up $5 here on this, the next strike up. And I'm going to hold down my control key, and I'm going to click on that. And now I have a short call vertical. But I'm not done yet. I'm going to do a long call vertical. Where do I want the stock to stay above? Well, I want the stock to stay above the strike. And again, I'm going to go to about a 20% chance of it actually going past that level. And so 80 implies that there's about an 80% chance it stays above that level. So that's what I'm going to look at. I'm going to go and I'm going to sell this guy. I'm going to click on the control key, sell this. I'm going to buy this one. And now what I have is a Condor trade. So here's what we're going to do. We're going to analyze this trade. I'm just going to right click on it. I'm going to analyze this trade, go to risk profile. And here we go. This is what it looks like. Now we said May 23rd. We're going to make sure we have May 24th there. And what I'm going to do is I'm going to right click on this. I'm going to set my slices to break even on this. And here we go. So this is a higher probability trade, but there's a price, right? There's always a price. It's about a 60% chance of us being within our break-even points. Break-even points are about 223 and 256, okay? I'm just going to jot that down real quick. 223 and 256 are our break-evens. All right. So our odds of being break-even, going back to probability, it's not a guarantee, at expiration, if we just let it ride to expiration, are roughly 60%. Now, that's great, that's well and good, but the challenge is we risk more than we potentially gain on this trade. That's the price of a higher probability trade. We risk more than we potentially gain. Is that something that fits what you want? Well, great. That's fine. This is a debit spread. Let's look at our price slices on this. Okay. So let me actually do that. I'm going to add a slice to the current price. So we're going to look right on this level right here. Offset 0. That means this is where we're currently at right now. Our theta is 450 on this trade. We're making about $4.50 a day, everything else being equal, okay? Say the stock doesn't move, applied volatilities doesn't change. We're making about $4.30 here a day on time decay on that, okay? That's an unrealized gain when I say that, but that's what a lot of traders like to do, and that's one of the benefits of this trade. Vega is negative. Implied volatilities. The plan is for implied volatilities to go down. Let's look at implied volatility on this. Well, implied volatility had spiked before earnings. We're past earnings, by the way, and that was I didn't mention that, but that was an intentional call on my part, was just to not, I wasn't even going to deal with the stock that was about to have earnings. And implied volatilities come down. Now, I don't know where it's going. If it goes down further, it's going to benefit. If it goes up, it's going to benefit us. If it stays sideways, then volatility is not that big an issue for us. So I don't know. I mean, eventually, before the next earnings, probably expect implied volatilities to go up before the next earnings, but that's a ways away. And also, this spike in volatility isn't all earnings. Because if you look at the past earnings, you can see, well, yeah, maybe it went up a little bit, but it didn't go up that much. The market was crashing. So you factor those two things together, you have that implied volatility spike. So in other words, it's certainly possible our IV could go up like that, but it seems perhaps less likely in that case. I don't know. But let's look back at this trade here. So here's our trade. Now, something to be aware of is, yes, the reward to risk isn't great in terms of we risk more than we potentially gain on this, but also this purple line, I'm going to draw over it with just like a little yellow here. The purple line represents our profit loss today. Okay. I guess technically I should have this date one day further, but it's not going to be that big a difference here. But notice this. Let's say the stock completely goes against us. Stock goes up to $265 up here. Let's say it does that. That's absolutely not what we're forecasting. But if it were to do that, at expiration, this represents a max loss down here. That's bad news. But if it does it quickly, and the quicker the better, I guess, in that regard, then our max loss isn't going to be anywhere near expected max loss. I don't know exactly where it'll be. Our expected loss won't be anywhere near what our max loss potentially could be. So now the same thing is true. If the stock goes up, it's going to take a little while to make money on this because we're making money primarily through the time decay. Okay. So Same thing on the downside. If it goes down, yeah, it could go down to 215 or something like here. Here's our max loss. But if it goes down there before expiration, we're probably not going to be anywhere near that max loss. Orion says, why do we risk more than we gain given the probability is greater than 50%? Yeah. So when you're thinking about probability, and I appreciate the question, on almost any trade, you can kind of think of probability this way, as kind of like think of it as like an old-fashioned scale, a balance scale or a teeter-totter or something like this. If the probability goes up, our reward or risk is going to go down, and vice versa. Okay. If you think about it, it's kind of got to be that way, because otherwise, that's supposed to be probability. Otherwise, everybody would just always do high probability trades with high reward to risk ratios. There's no free lunches out there, folks. If you're getting a higher probability trade, you're sacrificing on your reward to risk there. Okay? So there you go. Now, George said, what about expected value then? Now, keep in mind, when we're talking about that expected value, it's going back to something that I mentioned before. If we were just to let this go to expiration, first of all, this probability here, our probability here is at break even. It's not at max gain or max loss. So that's at break even. Our max loss is actually down here, further out from our break even points. So in other words, if we were let it go all the way to expiration, the probabilities are greater, are even greater than that initial calculation, because to get to max loss. Secondly, our goal is we're not going to take a max loss. We're not going to, hopefully, no guarantees, hopefully we're not going to get anywhere near that max loss area. So we're going to put some exits on that trade too. So that's going to try and help with those values there on that. So let's do that trade here. So what I'm going to do though is go back here, and I'm going to put some exits on this trade. What I'm going to say is this. I'm going to say, if the stock goes against us, if we start to break above our levels here, okay, start to break above our levels here, and I'm going to call this kind of a resistance level right here. I'm going to go to our bounce there, our break there, and our high point right there, okay? And I'm going to call that kind of a resistance level, okay? Let's do this. Let's go, where's the support? Well, support is going to be down here, is going to be a kind of a one support level on this. Okay? Now, there may be more. There's certainly this level down here. So if my expectation is that the stock is going to kind of stay in this zone, what I can do is I can say, well, look, if the stock starts to break out of that zone, then I'm going to exit the trade. All right? Then I'm going to exit the trade. So let's do that. Now, touching is not the point I'm going to say we're going to exit the trade. I'm going to say I want to break above that. So I'm going to say above 260, even though 260 is a little bit above my resistance level. Okay? And I'm also going to say below, well, say 220, that's below our support level. So I'm going to go to 260, and I'm going to go to 220 here on this. 260 and 220. And I'm going to put an exit on that trade in this case. So here's how we're going to do it. Let me go here, and let me go and go to the trade. I'm going to change this from single order for a first trigger to a first trigger sequential order. I'm going to right click on this, and I'm going to create an opposite order. Now, this is to get me in. This is to get me out, okay? And I'm going to click on market. I'm going to click on good till canceled because I don't want this to expire at the end of the day. I'm going to click on my gear and I'm going to say, I'm going to scroll on down and I'm going to say, under conditions, we can say, look, this is when I want this order to submit at, or when I want to cancel, but that's not what I'm going to do. I'm going to say, look, I want this order to be valid when JPM marks greater than or equal to, and we said 260 to get us out. JPM marks less than or equal to 220. You can tweak these. If your resistance level is different, support level is different, put in a different number there. So I can click on save there. And so does that guarantee me that I'm not going to take a max loss? It doesn't, but it would be unlikely if we were to take a max loss in this case. Okay, it would be very unlikely that we're going to take a max loss in that case. So I'm going to confirm and send, and I'm going to click on, my more neutral trades category, which is right here. I need to maybe just call that more neutral trades. Send that, and hasn't filled there. It just filled there. Okay, now that's a Condor trade. Now, let me go back to my charts here. So again, it would benefit if implied volatilities drop. This were calls, we could just as easily do puts. The numbers, I'm not going to go through the whole trade here, but if I wanted to do it as a put trade, what deltas would I use? Well, for my bull put spread, I'd probably have my short put around the 20 level. For the bear put spread, I'd probably have my put around the 81 level there. Okay, on that. Okay, let's just do a quick market check here on this, and then I want to get to some management here on this in just one sec and talk about management of this trade. We put in the prime management of the trade already. Here's the SPX right now. And maybe pulled off a little bit, down about 1%. You know, for those of you like 1%, look, we're still way up from where we were on that. We've had a pretty big pullback. We had a big pullback. It's come back a long ways, but in my mind, the interesting thing about this pullback is we're kind of right at our resistance level, so we'll see if that level holds. Okay, let's go and let's talk about management, because on JP Morgan, this trade we just did, if we breach our sides, then we put in automatic exits on this. You don't have to put in those automatic exits. And keep in mind, just because we're not guaranteed any prices here of when it gets out, even if this fills. But we're going to do this. So if things are going south on us, in other words, things are going against us, if we break above here, we get out. Break down below there, we get out. If we stay neutral, time decay should be helping us out. Okay. But at a certain point, we're going to look to get out. Remember, short options can be assigned early. We have, in this case, we have a long call vertical. We have a short call here that is in the money. It can be assigned, even out of the money, technically could be assigned early, but in the money are more likely to be assigned early. So we're not probably going to look to let this thing go within, less than a week till expiration, 7 days till expiration, looking to exit on that. Okay, so that would be a good scenario because that means we're staying within this thing. These trades tend to move pretty slowly on those. Okay. Now, there's other trades we have in the market that I want to talk about. One is in terms of trade management, we have a short call vertical on UPS. Let's take a look at UPS and see what we're doing at UPS. Short call vertical is a bearish trade. We put this on because it was trending down, and sure enough, it's continued to trend down. At this point, we have to ask ourselves, number one, are we under 10 days to go to expiration? Because in this class, that's how we're typically managing these. If we're under 10 days to go to expiration, we're going to get out. Well, we're not under 10 days to go to expiration, so I'm going to let that sit. Have we had a technical breakdown? Well, we just looked at the chart, and no, this is a bearish trade, and the stock has gone down, so technically it's doing what we had hoped it would do. The last thing is, if we've made, say, 80% of what we can potentially make on this, then we're going to look to get out. Well, hey, look, when we initially did this trade, we sold this for 70 cents. That's per contract. We did 3 contracts. Right now, the value is about 14 cents. Okay? So what would an 80% gain represent on this? The 80% gain would be if I multiply 70 times 0.2. You can do the math on that. You don't need a calculator for that. 2 times 7 is 14. I come up with 14 cents. In other words, if we sell this up front for 70 cents and we're only paying 14 cents to buy back, that's an 80% gain. Do you see the math on that? Now, you could do it differently. I could say, well, 70 cents, and to make 80%, I'm going to go times 0.8. That's 56 cents, and subtract 56 cents from 70, come up with 14. To me, it's a lot easier just to multiply that times 0.2. That gives me the 80% gain. Okay. You can also add a profit loss percentage on there if you want. Column. I don't have that on there, but you can add that on there to try and help you out on that trade. But point is, we've made most of what we could make. We're not going to let this go against us. We're just going to get out of this trade in terms of our management. I'm going to highlight that, and I'm going to create a closing order. I'm going to buy that back. I'll go just above the mid price, confirm and send, and we're going to send that order. Okay, we're out of UPS. We took a gain on that, and so that's how we're going to manage that. Now, there's a couple. Now, we have some trades that aren't doing so hot right now. Let me go to long verticals, and this actually is turned out DHR. This is, what do we have? We have a long put vertical here. It's a bearish trade. Are we within 10 days to expiration? No, we're not within 10 days to expiration. This is a bearish trade. And I want to look at the chart here on DHR though. Okay. This is a long put vertical. Because all these trades, our technical analysis is a consideration. What are our strikes? Our strikes are 200 and 195. 200 and 195. Well, here's the thing. This is kind of a resistance level we're at right here. I don't have a stop on this trade right now. I do not have a stop on this trade right now. I want to add in a stop. So why? Because if this breaks resistance on me, then that's not a good thing, because we want it to stay down. Now, how are we doing relatively well on this trade, even though we're kind of near the upper strike on this? Well, one thing is, probably implied volatilities have probably helped us because we held that one through earnings on that. Okay? So here's my resistance level. I'm going to say if we break above that, I'm going to go maybe 1% above that. So from 200 to 202, I'm going to get out of that trade. This trade is doing okay. There's really no huge concerns on this, but I want to put on that added protection on that trade. So that's how I'm going to manage this. I'm going to right click on this. I'm going to create a closing order to get out. And for this, I'm going to click on market. I'm going to click on good till canceled. And we said if it marks greater than or equal to 202, we're going to look to get out of that trade. Okay. Otherwise, we're going to let this sit. Our theory is we're going to let this, and this resistance level is going to hold. Okay. That's our line in the sand, the resistance level there. Okay. So in terms of support and resistance, whenever we're talking about support and resistance, whether we're talking support or resistance, whether we're talking about diagonal support or resistance or horizontal support or resistance, the more touches typically, this is just I saw in the chat, George said, more touches is more valid. Yeah, it tends to strengthen what we would perceive the support or resistance level to be. So there's our stop. Now I do want to do, let's do another trade here. We got calendar spread. So this is more of a neutral type trade. This is on LMT, and this is a trade we're losing money on. It's actually gotten a little bit better today on this. We're down a little bit. This is a 460 calendar. When we get below 10 days till expiration, we're going to look to either close this out or to roll it. Close it or roll it. And what we're going to do to make that decision at that point is, if it's a trade where we still think it's going to be kind of neutral and stay, remember our target on a calendar spread is the strikes, 460. If we still think that's a good target, then we'll simply roll this out. We'll go from May to maybe early June at that point, but we're not there yet. We still have 16 days to go, so I'm going to sit on that one there in terms of rolling. But what about in terms of just, hey, is this breaking down? Do we still have a expectation that 460 is a decent target price on that? Well, let's take a look at the chart. LMT. So let me go to charts. LMT. Where do we want the stock to go? 460 is our target. That's our target. Does that sound reasonable? Well, yeah, I would say, what I'd say though is we have bounced off this. Look, if I were to, actually, let me do this. I'm going to draw a line differently. I'm going to draw it with my drawing tool here, okay? So I'm going to draw this with this drawing tool, and we're going to count. How many different touches do we have on this? And this is kind of going to something George said. The more touches, the more. That was a bounce. Now, we did break below that, but we gapped down to that level. Intraday, in terms of closing prices, we hit there, we hit there, we hit there, we hit there. Do you see why we can consider that as a support level or a resistance level, excuse me, on that? That's why we're considering that a resistance level. If this bounces down from this, it's likely to go more towards that 460 level, which is our target, which is what we want. And if we get to the 460 level on a calendar spread, when we hit the level of our strike on a calendar spread, we will look to roll at that point or close at that point, because that's kind of like the best case scenario. In other words, if our target is 460 and we go down to 460, and let's say we have 10 days to go, 15 days to go to expiration, what are the odds that it's going to stay at 460? Now, if it does stay at 460, that's great. That's even better. But in my mind, if we're at a certain point, if we're at an ideal point, that is the strike price, 460, the odds of it staying there are probably pretty slim. Even if we don't have a discernible direction on it, it's probably going to go somewhere. So in this case, though, that's not what we're looking at. In this case, we're at about 475, but the expectation is this resistance is going to hold and it's going to go back down to 460. So we'll look to get out at that point. But I'm also going to say, if this relatively strong resistance breaks, then what I'm going to do is I'm going to look to get out. That's at about 475. I'm going to say about 480. Okay, I'm going to go about 1% above my resistance. My resistance is at 475. I'm just going to round. About 1% of 475 or $480 is roughly $5. So that's going to put my exit point at $480. So I'm just going to do that. So that's the management on this, right? 480. Okay, so let's go here. We're going to put in this just as kind of protection. It doesn't guarantee we're going to make a gain. In fact, we're at a losing point right now, but we don't want that losing point to get too bad on us. So I'm going to right click on this. I'm going to create this. We're going to sell this if we break above that 480 level. LMT marks greater than or equal to 480. And one thing I would say also is this. When you do this, we confirm and send, and you're looking at your positions here, there may be certain positions you want to stop on, and maybe some you don't want to stop on. For example, maybe you don't have a stop on a long-term stock trade or something like that. That could be the case. Or maybe it's a vertical spread where you say, look, the reason I'm doing the spread is I'm limiting my loss by doing the spread. That's why I'm not doing just a short call or a short put. I'm doing that spread because my loss is defined there and I'm willing to take that loss and let it run. But if it's something where you want stops on these, if you want exit points on these, just use this. And sometimes you miss it, probably. Just double check. And then periodically you'll want to check your stops there along the way on that. Okay? So there we go. I think those are the main ones I wanted to manage today. Coming up next, we have trading price patterns. So if you are interested in technical analysis, check out our trading price pattern class. And because, we talk about it. We talk about here price patterns in this class some. We talk about support and resistance levels, which really, when you talk about price patterns, it really comes down to support and resistance levels, okay? When you have a triangle, you have support levels, you have resistance levels that you're looking for breakouts on that, all right? Now, so this is kind of a more unusual type trade we went through today. Before we did our management, we looked at a condor spread. They're kind of a little bit more unusual. I would say iron condors are more popular probably, and the reason iron condors are more popular is, I think one reason is all the legs are out of the money in the case of an iron condor. On this, you have one that's in the money. Other than that, there's not a huge difference between those in terms of reward to risk, profit loss, availability, probabilities. They just depend on the strikes that you do. So you can certainly do either, but sometimes what happens is you may be in a particular trade and you add in the other side of that equation. In other words, let's say you have a short call vertical spread and later you add on a long call vertical. You end up, when all is said and done, with that condor spread. It doesn't matter if you know the name for it. The point is, we want to give you management tools whatever the names are for these trades that you do, some common sense management on those. All right, everybody. Thanks for joining me today. Thanks, James, for helping me on the chat. And we will see you all same time next week. Bye-bye, everybody.